So let's go resolve those community questions about Darwinex ZERO, many of them recurring, so you can make better decisions. On this platform, disclaimer. And we begin. We start with the first one, very common, related to operations in Darwinex. Look, Angela Beltran tells us the following from the Discord community. Due to the bad streak of my strategy in November and December, the drawdown dropped to 18% and I'm still trading. Will it be viable to continue with Darwin? My VAR is 2.66% and my multiplier is 1.86. If the VAR multiplies everything by 1.86, my drawdown is 36% for Darwin, not 18%. I'm not clear on the multiplier, how it works or replicates profits and losses and the risk engine. And Martin Jungler asks us on Instagram something similar about his trading. I have funding accounts, I risk only 1% when trading, and I make profits of 5 to 8% monthly. I want to join Darwinex because it's something more real. Funding accounts are an uncertainty where we don't know when they'll blow up the account. Risking 1%, there are times I take trades where I buy 10 lots and others where I buy 5 depending on what my stop loss indicates. My doubt is if that affects the VAR that's driving me crazy because I can't understand if my trading method, even though profitable, will work. Thanks a lot. Thank you, Martin and Angela, for sending in this question. Okay, there are 2 points to consider here. The functioning of VAR, which is risk management, and the size of the positions or the distance of the stop losses, which is the monetary management of the strategy. They are not the same, don't confuse them. We'll start with the second. The monetary management of a strategy is the initial limits of the position, that is, what size we use to build the position, the lot size. What distance of losses are we going to assume, which can be measured in pips, in percentages of the account, etc. And how many trades or positions we take in a given time period, such as a day or a month. For instance, Martin chooses to trade with positions ranging from 5 to 10 lots, based on his stop loss signal, to accept a maximum loss of 1% of the account per trade. Suppose he always trades with 5 lots per trade, meaning he'd lose at most 1% of the account, which is $1,000 per trade. But is the risk defined? Not really. It's not the same to make 1 trade a day for a month with this monetary management as it is to make 5 trades. In the first option, we would be willing to lose $1,000, while in the second, it would be $5,000. In addition to this, we must take into account the losing streaks of our strategy. Are they streaks of 5 losing trades? 10 trades? What I mean by all this is that our main goal in Darwinex is to attract capital from investors who trust our performance, our ability to generate returns from the market, but to do so, we must earn their trust. And to do that, the first thing we must quantify is the risk we are assuming. Without that data, the investor will not be able to make informed decisions about what risk they will be taking when investing their money with us as traders. And with only that money management, we are not defining that risk. So, now, let's move on to the second point. Darwinex has a risk management engine, an algorithm whose function is to limit the risk of all traders with the same VAR. VAR, or value at risk, is defined by answering 3 questions. How much can I potentially lose? With what probability, and in what time horizon? Meaning, what minimum percentage of capital could I lose in a given time period and with what probability? The reason for this is that the investor can make decisions by comparing all available assets, or Darwinex in this case, using the same risk measure. For instance, if I wanted to invest using copy trading on another platform and had 2 traders to choose from, and one of them has a return of 6% and the other 14%, which trader would be best to copy? Well, I don't know, because information is missing. Specifically, information about the risk each is taking to get those returns is missing. Initially, we might think the best option is the one earning 14% higher returns. But it could be that to reach those numbers, they are taking an excessive risk of 20% VAR. The other, however, might be doing excellent risk management and only assumes 0.5%. This, in a very simplified explanation, means one risks 0.5 units to earn 6, and the other risks 20 units to earn 14. This, explained like this, is very simple. The problem is that in this hypothetical exercise, we have the 2 variables, the percentage of return the trader obtains, and the percentage of risk they assume. But on that other platform, we don't have the second variable. They don't provide us with that data. In this way, Darwinex ZERO, with its risk management engine, is standardizing all Darwins to the same known risk level. 6.5% VAR monthly at a 95% confidence level. It assures the investor that they will not lose more than 6.5% of their invested capital during 19 months out of 20, or 95% of the time. Therefore, only 1 month out of 20, or 5% of the time, could they lose more than that 6.5% to which they are limited. In other words, Darwinex is defining for us that risk. If you like this type of content, give it a like. Okay, Alberto, but you still haven't answered the question. Will the strategy work in Darwinex ZERO with that variation in lot size? Well, probably not. And not because the strategy is bad, but because Darwinex's risk management engine works better with strategies that operate consistently, or in the most similar way possible. I'll explain. To keep the algorithm from going crazy and define your operation's risk, always give it the same data type. In other words, it's better to always trade with a determined lot size, whether it's 1, 3, or 5 lots, but always with the same lot size per operation, always with the same maximum possible loss, always with a similar duration for the operations. The more alike operations are, the more precise the risk engine can be. Failure to do so will result in fluctuations that cause the algorithm's risk assessment to become erratic, preventing you from having comprehensive control over the potential returns you might achieve in your Darwin. That is to say, it could happen that, on a good trade, the risk management engine assigned you a very high risk due to previous operations, and it replicates your signal in the Darwin with much less lot size than you executed in your trading account. To put it another way, when the operation is good, you will obtain very little profit, and when it is bad, you'll have big losses. Therefore, it's always better to be consistent, or as close as possible. Instead of trading with a range between 5 and 10 lots, do it with a range between 4 and 6 lots. The risk engine won't be as precise as it could be, but it'll be better than with wider ranges in the lot sizes of the operations. And since the video is becoming a bit long and dense, I'll leave you the second part. Here, go on, see you inside. See you next time.